Hi, quick intro of myself. I'm Gharakhanian, founding partner at Silicon Legal. We're a boutique firm representing startups and investors. Also the creators of the not so subtle sponsorship branding you may have been inundated with downstairs. Great panel here with a lot of great investors spanning seed through Series A. And I was thinking today about that old question, what's in a name? Thankfully, I'm not going to quiz everybody on Shakespeare. But you know, we heard in that last panel around a supersized Series A, so much discussion trying to characterize what is a seed, what is a small a, what's a large A. And so I think it would be helpful for all of us to get your perspectives on that sort of threshold question. What do you view as a post-seed round? And what's the difference between that and a small Series A?
I really think we ought to change the names completely to like something that doesn't have a hierarchical order, you know, something like colors or something. They're blue round and green round, or, you know, that doesn't mean anything. Because it all changes. It changes all the time, and it changes based on what company comes in that day. I mean, you know, we look at it as seed is still pretty much concept stage, very early. You know, maybe they're starting to get product market fit, at least in theory, and they're starting to test things and, you know, get a little bit of signal. And then skipping over post-seed and early A for a second, jump into A, there's more signal there. There's something there. There's something built. There's the beginning of a team. There's, you know, it looks like a business. And you're trying to prove that it's a scalable, capital efficient, can get big type of business, and then that gets into Series B land. But what is post-seed and what is early A? It's impossible to come up with one definition of that. It changes for every company that comes in.
Marc, do you have a perspective on this?
Yeah, I don't really think it matters what you call it. It's more relative to the performance of the company. So, you know, I am a fund very similar to Bullpen, but located in New York, with very much the same thesis that there's this big gap happening for a large group of companies that are reaching, you know, product market fit. They're scaling their revenues. The management team has proven that they know how to build a business. And now they're stuck because the A market has gotten away from them. Mm-hmm. So for me, it's more about how is the company performing, not, you know, what is the label on the round so much.
Anyone else have anything to add to that? That performance angle sounds like that's really what it comes down to. It's not necessarily a numbers valuation angle, an investment amount, but it's really a stage of company performance.
Yeah, I think that the nomenclature is mostly helpful to talk about, to give entrepreneurs guidance so that they have a sense of how the variety of VCs are thinking about things, and so they can communicate effectively and sort of calibrate their expectations appropriately and communicate an ask that makes sense for the stage of where their business is.
Mm-hmm. So moving on, another question I've been thinking about. When Paul Martino sort of introduced the concept of post-seed and seed as a process in a 2014 TechCrunch article, there was a quote that stuck with me. He said, "The public at large frequently only sees the big financing round or even the increasingly common supersize A round and doesn't wait to get, or does not get the visibility into the rolling notes underneath, the rolling extensions underneath the surface that carried the company along all the way." I think that as a startup lawyer or as an investor, you have a heightened visibility to post-seed rounds through portfolios, through deal flow. But is post-seed, or is the seed as a process much larger than it appears?
So I'm a partner at a seed fund, and I was crunching the data for this a couple days ago, and we've had about 30 investments raise follow-on funding, which could vary from post-seed to Series A to both, you know. And so out of those 30, it was pretty evenly split between 10 companies just went straight to the next round, like the, you know, full-sized A. 10 had a post-seed round, and 10, you know, 10 had a post-seed round where they needed it, and then 10 had a post-seed where they weren't ready for an A, but they had sort of, you know, preemptive offers to put a little more money in, so they took it because it was on good terms. And what I thought was interesting is we have really good companies in each of those buckets, So it's sort of like, it's not like all the good ones are focused, concentrated and they went straight to the A or they didn't. And I think we are seeing a lot more companies going through, 1, 2, 3 notes after a seed round, and that's, it seems to work just fine.
If you think about it, that this first financing to second series financing, like irrespective of what you call them, these days first series financing is most typically, at least in the Bay Area, a convertible note or a safe. And then that next round, whether it's called Series Seed or Series A or Seed Prime or whatever it is oftentimes the first priced round. If you think about it, getting from a certain point of revenue to the next certain point of revenue, right? Getting from, if you work backwards, getting from to D from C to C from B, from A to B, those are going to be, you're already your sales model, your customer acquisition model is already to some degree working. So there's a degree of predictability of, I take in this much money, I spend this much money, I grow the team this much, I know where that's going to get me, and I have a reasonable sense of what I'll be able to raise based on those forecasted metrics. But getting from sort of cold start to a business that you can sort of apply resource to scale, that is inherently the least knowable and predictable portion, right? Is the 0 to 1. So it makes sense that there's that there might be a lot of needs for runway extender or interim financings. And historically, I'm now in my 16th year of VC. Historically, we were much less creative on the marketing side, and each new financing would get a new moniker. But the unfortunate artifact of that is you have relatively early stage businesses that are already at Series C, and it looks like a broken company, even though in aggregate they may have only raised $4 million. So this is a little bit of a solution to that, right? A lot of it is just optics, right? It's kind of like what you said, who cares what it gets called? But unfortunately, the later stage capital does seem to care, so we have to be responsive to that.
So in answer to your question, is there a lot more money behind the seed rounds prior to the A round? The answer is definitely yes. Okay, there's a lot of bridges that take place, a lot of additional, seed plus rounds, whatever you want to call them. But it's not necessarily a bad thing. Look, if the companies are progressing well, and they're just not quite ready to raise that next bigger round, the next price round, there's nothing wrong with continuing to support your companies. We do it, and we're happy to do it as long as we feel they're going to get to a successful Series A or B, whatever the next round is.
Do you think that founders sometimes have a perception, if they've iterated and they've used seed and they've figured it out, but they need more money to really become an A company? Is there sometimes a perception that founders have that maybe I don't have an alternative? Like I'm not an A company, so we're going to sell. Have you come across situations where founders are maybe less than hopeful or still need more education about the prevalence and availability of post-seed capital?
I think very much so. I think a lot of them naively think that they're going to raise their seed fund, stand up a product, get a little bit of traction, and immediately jump to the A. And it's not their fault. They don't really understand what's happening in the financing market, how the A market has changed. I think it's important as these entrepreneurs raise their seed capital that they understand the follow-on capacity of their seed funders, because there are a raft of new seed funds that have been created. I think Duncan said 350 seed funds. Some of those funds have capacity to follow on, but many do not. And so it's important that you understand the funding capacity of the syndicate of seed funders that you have.
So jumping ahead to just a general global trend question. While 2016 didn't bring a nightmarish disaster to VC, we did see valuations coming down, being more reasonable. We saw more of a rigorous bottom-up analysis from investors when evaluating investments. How has this shifting market lens impacted the way that a post-seed investor would evaluate a post-seed opportunity?
So I think the main difference I've seen is that founders get less credit now for revenue than they used to. So I think, a couple of years ago, pre-revenue, maybe you're at a 5 or 6 cap. And then if you get to, let's say, 40K MRR, you're at, a 10 or 11 cap. Now, entry level is still 5 or 6, but 40K MRR might get you to like an 8 cap. And I think sometimes, founders get frustrated because it feels like they made a lot of progress. But because there are so many companies kind of reaching the stage where they have good revenues, but not quite enough for a Series A, the revenue, the multiples have kind of come down, on the post-seed side, I think.
Mm-hmm.
I guess for us as who sit in the middle, post-seed, pre-big A, for lack of a better term, now that the market, we have to understand where the A market has gone, where the B market has gone, all right? Because the risk we're taking is that we're not giving this company enough capital to get there. So the things we're looking at is that growth rate, can we extrapolate out that growth rate that we think they're going to hit those metrics, that they can comfortably raise that A? Or if not, how close to profitability can they get so that they can hedge that risk going forward? So that's the other thing we're looking at.
Yeah, I think Marc makes a great point. The seed investors are now more so taking into account the likelihood of that company being successful at raising the Series A. Mm-hmm. And what they really need to get there, as opposed to just, is it a great idea? Is this a good entrepreneur? Let's just immediately give him some money. There's more thought going into it now.
Yeah, so we invest almost exclusively in B2B internet software recurring revenue businesses, so that's what I can talk to. And we're typically leading or co-leading first priced round is our typical entry point. And the landscape has definitely changed. I would say that 18 months ago, beginning of 2015, you're growing nicely, you hit $1 million ARR, you got a 20 pre if you're a Bay Area company. I think there's a Bay Area premium everywhere else discount, which has endured and is probably justified. And I think that especially sort of there was a big correction in the public market prices for SaaS companies in Q1 of this year. And that sort of popped the bubble of unbridled enthusiasm and unrealistic valuations. Interestingly, those public market comps have come back. But I think that was a wake-up call to the investor base to sort of recognize that while it is no small accomplishment to get to $1 million ARR and be growing nicely, you're actually not that scarce. Like, there are a decent number of those. So we shouldn't just invest in every single one. Let's get more picky. And what is kind of happening is that, now it's a $2 million ARR to get that same valuation, and that shakes out a bunch of the companies. So there is a smaller pool of investors who are looking at those businesses that are sort of, call it 50 to 150K in MRR.
Mm-hmm. So if I'm a CEO and I'm looking to raise a post-seed or raise a small Series A, what should I know about the size and structure of the funds that I'm approaching?
Well, I think you want to be meaningful to the fund, right? If you're just a tiny amount of money in a much larger fund, they're not going to care that much about you. Mm-hmm. So I think you want to be meaningful. You want to make sure they have reserves. They can support you, at least through the next round or two, doing their pro rata. But look, I think the most important thing is just, do you really click with the partner you're going to be working with? Are they going to be super helpful to the company, not just in building the business, but guiding you to be able to do those next funding rounds? Mm-hmm. I mean, that's just so much more important at the earlier stages of a business than the rest.
I think that good points by everyone on the panel. I think that it sounds really good to get big funds in your early rounds, in your seed round, in your post-seed round, because you believe then that they've got sort of lots and lots of capacity available to you in subsequent rounds. I think and those bigger funds will try to convince you that there is not a signaling issue, but I've experienced it with a lot of companies where even if we're leading and we fill out a round with some bigger funds, the instant question is, why isn't that bigger fund leading your next round, your Series A? Mm-hmm. And at one point with one founder, his belief was, well, we've got 4 of them, so we've mitigated the signaling issue because obviously we're going to run a process. And we kind of multiplied the signaling issue by 4. Because everyone knew one of those firms, and there were various reasons why each one of those wasn't stepping up. But it was a challenge. So I think it's a little bit like Goldilocks, find just the right fit. Like build a syndicate that can provide you with a good runway extender if you need it, but also build a syndicate of firms that are not a natural lead for your next round.
So I think in terms of fund size, I think most funds enter for 1 or 2% of their fund size initially. So, if you need to raise 3 million, you probably want to target a fund that's, 150, 200, 250 million. you're going to like a $50 million fund, it's not a good fit for them. And I think for founders, the best advice is probably just to think backwards from the investor's perspective, which is when they put in $1 million or $2 million, they want to see, in your next round, how does that become 3x or 5x that, and how does it become large over time? And I think one thing I've seen in post-seeds is sometimes people have this plan of, I'll raise at 15 now so I can raise at 20 or 25 in a year. And then most investors will kind of say, well, come back in a year and maybe I'll invest at 20 or 25 because, that's better kind of risk return for me.
Marc?
No, I just want to echo a point that I think Jared made about making sure that you have the right, or maybe it was Jim, the right types of investors. It's great to have these big funds who put in, $250 into your seed round. But one of our best deals was a company that had been funded by Spark and SoftBank, two of the best names in the industry. The company had gotten going and was developing very nicely. I think at the time we invested, they were doing about $50,000 a month in revenue and growing very fast. Very unique product, very unique market, huge market. Go and get those two funds to invest. And so that turned into our opportunity. But had we not been there, I think this company would have folded. Today, that company's gone on to raise both a Series A and Series B and is doing over $2 million a month at this point.
So you all sort of talked about these notions of funds and selecting a fund where you're going to be meaningful, where they're going to add a lot of value. For a post-seed company in particular, is there any shifting to your sort of internal board member / investor advisor hat that you're wearing when you're trying to add value? Is there a slightly different perspective that you take with a post-seed company who's had some investment, figured it out, and is now ready with that new idea to do something different?
I think for me, it's about making sure that we are top grading the team. So, you may start out with a suboptimal team in a seed round, but as the company starts to scale, you need to start thinking about who's going to be able to take this to the promised land. And the team that you started with often isn't the team that can fully get it there. And so I really focus on, do we have the very best people in each of the key critical slots? And if not, let's go get them.
Yeah, you think about sort of the task the typical task required for a company at that stage. I think first and foremost is team building, and the other is sort of building a scalable market engagement model, right? How do you get lead flow? How do you convert those leads into sales? How do you do that repeatedly? How do you price? How do you contract? Building customer success. So there's a set of competencies in B2B that we're helping those companies develop during that stage, and those tend to be those. Proving out those capabilities are the things that get you a good, next round, whether it's called a Series A or a Series B.
Jed?
Well said. I think that was well said. We're mostly a Series A fund, right? Our current fund's 125 million. We do some seed, and when we do seed, we set aside our Series A reserves and beyond. So we treat it as if it's a Series A company, even though we might have written an initial smaller check. And we give them the same support that our Series A companies get.
Yeah.
So we're mainly a seed fund. I think when companies go post-seed, the one thing that changes in the advice is that when you're seed, usually, if you're doing reasonably well, you can raise a post-seed. I think that doesn't apply as much as post-seed. Like once you've raised, 4 or 5 million total, like if you can't get to an A from that, it's very hard to get additional capital. So I think we often, even more than at a seed stage, we'll tell people like this might be the last money you get unless you can reach, the Series A kind of metrics and milestones.
I think we're getting close to the end. Any sort of last words of advice or caution or just wisdom for any of the entrepreneurs in the audience?
Yeah, I mean, look, raising Series A is hard. Right, there's way more companies that get seed financing than ever succeed getting Series A financing. So, you have a double challenge. You're trying to create your business and get started, and starting recruiting and getting a product market fit and initial sales, all that stuff. But you also have to have the I need to eventually raise a Series A mindset, and start relationships with investors and start thinking about the metrics they're going to want to see and the proof points they're going to want to see and start thinking about how much capital you really need at that round to make it to the next round with plenty of room to spare, so you have time to fundraise. So I think when you do take seed financing, make sure you at least get some people, some investors that are going to help you think that through and prepare yourself for eventual going out and raising the Series A.
I guess my piece of advice is, when capital is easy to get, you can afford to make more mistakes. You can afford to spend a little more aggressively, et cetera. Capital, we're now in a tighter market. And so I would say, spend as little as you need to spend out of that seed round to get to product market fit. And not, if you're having to iterate and pivot and iterate and pivot, and then at the very end, you finally figure it out, it's going to be tough.
Yeah, building on Marc's point, it's I'll put on my Captain Obvious uniform here for a minute. Like, the only reason companies fail is they run out of money. The dominant way that early stage companies fail is by premature scaling, right? If you don't know with confidence that you can hire sales reps and make them productive, don't hire sales reps yet. Don't do it and hope it'll work out. Like, keep on doing founder-based selling until you know that you've got that model nailed well enough that you can teach someone else to do it and they can go and pay for themselves in a few months. And that's true for after your post-seed round or after your Series A round as well. We closed a financing a week and a half ago, and we're having our first board meeting this week. And I got the board deck, and it's sort of, oh, okay, we're going to go hire a VP sales and 6 AEs. It's like, no, that's not a good idea. Like, you're not ready for that yet. Hire 2. Right? Because you've got some money in the bank. Make sure that you know that you can make them productive, and then take the learnings from that and figure out which are the next 2 you want to hire. So, there's no hard and fast rules here, right? The countervailing force is that every opportunity these days is time boxed, right? Because if it's a good opportunity, other people are going to recognize it's a good market opportunity, and you're going to have competition. But you're better off going slower and making sure that you're spending every dollar wisely than trying to go too fast and not having enough to show for on the business at the end of your runway.
And so this is less advice and more just an observation, but I'm very excited about kind of post-seed emerging over the last few years. I think 3-4 years ago, you could either raise at kind of a 5 to 10 million valuation for your seed, and then Series A is like 25 and plus. And it felt very strange that, if your company's worth 12 or 15 or 18 million dollars, like, you can't raise any money and you're gonna, maybe disappear. And so I think it's a real market efficiency to be able to provide capital at those stages.
Excellent. Well, thanks, guys. Appreciate it.
All right. Thank you.
Thanks.